Hi, this is Anna. Anna is going to speak about real insurance products, but we made up the company called Acapulco Insurance. This is the only part of this that is not real. So when Anna speaks, she's going to think to you about how some people say insurance products or investment products. She's going to go over a policy that is really used on one of the managers here's policies here. And we're going to let Anna do our speaking for us.
So here is an indexed universal life policy with a face, or named amount of $250,000. The policy amounts begin at $100,000, and they increase to any amount after this. For example, you can obtain a policy for $125,000. You can also ask an insurance agent to get a policy for over $1 million if you can prove your income, passive or active, and your assets make you attain these requirements.
So as Rosie pauses for a moment, let's look at that. It was originally, remember, a $250,000 policy. And on that $250,000 policy, she has all of this calculated for you. So this is supposed to be a dollar sign. And so, for instance, the quarterly payments on that policy are $1,260,000. Now, if this was for a person who was 49 and under, 50 and under, the quarterly payments would be less. And simply because the insurance companies know that you have less time to pay the policy out once you hit 50. And how do they know that? They look at life expectancies of people. They use actuarial tables, and they look at life expectancies, determining if you're 50, you probably will not live too much longer than 100. So they give you 50 years to pay. From that, they then say that by year 7, this is what you have accumulated in the policy. That's based on a quarterly amount. Now let's look at this number, 1,260. If you had actually done this as a monthly amount, you would actually be accumulating more. So this year 7, remember, if you break down or you divide 1,260 into 4 quarters, you'd have $315 per month. So now just think about that. If you were to do that per month, okay, it's the same thing, but let's say you went up on a monthly payment and you wanted this amount to go up. You want your U7 policy premiums that are accumulated, meaning that's what's in the policy, kind of like that's what's in the basket and what you have. And we'll get into uses on a couple more slides. So year 16 with this is actually also a no lapse premium period, meaning that if you paid $0 in this policy, no lapse. It's whatever you have. The insurance policy does not go down. You don't lose it, and you still have it and its values. Okay, so if you wanted to make sure that the policy went up to 500,000, all you'd have to do is increase your quarterly premium to $2,520. Originally it was 250, now you're taking it up. 250 times 2, of course, is 500,000. You're at $500,000 if you can figure out how to do that. Now here's the situation. $2,520 divided by 4 is $630 per month. Okay, that seems pretty high and pretty pricey, but if you don't, guess what? you're going to miss some premiums, and also you can go get less. All right, where are we getting this? We're going to have Rosie come back and talk to you about what these are, why we have the range up here, and what the loss is.
The range is the number from the lowest value to the highest value in a series of numbers. On the global index market, the highest range in a 20-year period is 13% and the lowest is 0.75%. This is less than 1% of an interest rate.
And on the Standard & Poor's index, you had negative 38.49% as a low. That seems really low. That's like negative 38 degrees as a temperature. That's pretty scary. But your highest was 29.60 of a high. This is a 20-year period, because as we're going to go on to the next slide and show you that you're really not losing as much in interest as you think. And when you get this negative number, you make up with it for a positive number. So this again is a range. This is as low as it went, this is as high as it went. But when we go over to the next, this is actually where we got this data. And again, this is based on a policy that was written. And you see how on the two slides before it said the mode is 12%. Look at that, it's in dark black, it's bolden. 12% was the average for years over a 20-year period. This is done from 2003 to 2022. They call it a 20-year period. It's really more like a 17-year period. But anyway, we'll get, here's a 12% here. Now look, 2003 it was 12%. 2004 it was 9% almost, or 8.999 rounded up. 4.70 2005, 11.65 2006, 3.65 2007, 2008 it was 0.75, 2009 12%, 2010 12%, 2011 1.54%, 2012 11.68%, 2013 12, 2014 11.39, 2015 0.75. Okay, 10.46, 12%, to 0.5. Okay, it's 12, 12, 12, 0.75. And that's why on the previous side you saw a range, but your average is really more of 8.5% is your interest. Now, for people who are old enough to remember interest rates that were this high, if you'd gone up years before this, like back in the 90s, those interest rates were like 13, 15, 14, easily. Okay, see, but those interest rates we haven't seen in a while on most index. Closest place you can get them is the stock market. Standard & Poor's index is one of the markets that's used in the stock market, and you can see that indexes are tied, or indices I should say, are tied to what people are investing. And what happens is those stocks and are in mutual funds, and those companies are tied to the basis of insurance. But the insurance companies tie to those indexes to get money. But at the same time, they actually have their own insurance products that insure you. So usually, even if you were to get a negative percentage, which you do not see on this chart, the insurance company's average would back you so that you would get an average interest rate of about 8.5 in this 17-year period. That's not bad, because if you have a basis for 250,000 and you don't take the money out, if you have a basis for 500,000, if you have a basis for 6 or for $1 million, you don't take it out. You actually can turn around and use it. Okay, and your interest is actually going to grow. And then when you get older, and I mean older so that like you don't have to worry about like who's going to take care of you, you have your insurance back to that as a precaution, because you can always use the insurance to provide a service for you, like you could provide as a monthly income as extra. You could take out cash value. So it's not so bad. So like I said, the mode was here. 8.5 was the average gain. That's not too bad on a product. The other one was the global. Put this in navy blue. Your global. Put this on Rosie's chest. Sorry. It's your global index here. Was 3.849. That's tied to a global market. And a global market, that's disrespectful in a way, so I'm going to erase it. A global market, though, I just want you to know that this is the global market. And it still is bad and you can't see it. But anyway, this is the global market. And so on the global market, you had a low of negative 38.49, but you had a high of 29.60. And this is really a range, not an average, because if you go to your average, even on that market, your average was an 8.5%. And just imagine if you were looking at this actual insurance portfolio, which you can ask the Jacobs Learning Center if a licensed insurance agent, if we have some will come out and talk to you, and you would actually look at this portfolio on the years when you had 23.45%. 29.60 was 2013. Okay, that was 10 years ago. 19.40 was 2017. And right during COVID, you were at 26.89. And 2020, right before COVID set in, you were at 16.26. And then 2019, you were at 28.88. So you had some high interest. So just think if people were using this policy during COVID, what could actually happen if they had it, okay? And how they could have actually said, hey, you know what? I have 500,000 stashed somewhere. In 2019, I received a 28.8% percentage. That's what it was. So 28.8 is really 28.9. I'm going to go on ahead and round. 28.9% on that, and said, you know what, I have an emergency, I've got to use that, and they had interest. Now, they had a negative 701 in 2018, but they had a 19.40 to balance it, because as you know from subtraction, this is all balancing out. So even on the months you're losing money, hopefully, just like in the stock market, you will gain. The point is, you have to stick around and wait to see if this happens.
The cap rate is the rate that is limited by the amount of interest that can be lost. The guaranteed minimum interest rate is 0.75%. Your face amount of $250,000 is guaranteed. Also, there is cash value that begins accumulating in year 4.
And here are the cash values that Anna started talking about. She had said there was a cash value to it as a benefit. You have 0 first year, 0 second year, 0 third year, and by year 4, $2,388. Now I know what you're saying. If you paid $1,260, and you did that 4 times a year, that comes out to $5,040. $5,040. Why is it your cash value is only 4? Well, that's because your cash value takes a while to accumulate. Most of your interest is going over towards the, unfortunately, let's talk about why people buy insurance, death benefit. Those of you who are parents out here know what I'm talking about. You don't want your kids, your children, I shouldn't say kids, your children to be left out. So the death benefit is what is actually getting that accumulated interest. Okay, but by year 10 you have $18,248,000. Do you accumulate? Is this the best accumulating vehicle, question mark, no, but it not in terms of cash. So I'm put not for cash, but for death benefit, yes it is. Because I'm going to show you what happens with the same policy value in the next slide. And once again, here's what happened with all that interest that we were talking about on the other slides. You have, because remember the original policy value's face amount is $250,000. So remember we had a minimum, the company promised us 0.75 floor. Minimum interest you would get, which is literally under 1%. And then what did it do for the floor was about 13, if you recall, about 13.79. 13.0. Looking at the policy, 13.0 was your cap rate. And cap in insurance works a little bit differently than the cap rate works in real estate. So don't confuse these. Cap is like kind of like an actual cap or floor. So here's what happened if you got anywhere in between these rates of 0.5. This is what it is alleging and purporting. Remember that this is not guaranteed. Remember, this is just like a synopsis. So this is like when I say it's not guaranteed, I wanted to get real honest with you and say I'm writing on Amazon. That's okay, but I wanted to say that it was not, the 0.75 is guaranteed. This amount may go up. Okay, so it may increase. And my M is really horrible, but it's MAY for it may. It is possible. This may go up, but this is what they're alleging is a guarantee. $374,000, even though there's no cash surrender value. It's the same year that if something were to happen to you, God forbid, let's say you have 4 children, they could divide that out. Get about $62,000 and some change. There's no cash value here in year 2, but you have $254,710. Guess what? That's another $4,710 where your interest is going. Year 3, same thing. Year 4, you're up $8,763. Year 5, you're up another almost 10,000. In fact, a little bit more than 10,000. 10,644,000. Say that right? 10,644,000. Okay, year 6, you're up about 12,456,000. And year 7, you're up about 14,202. Here you are, 15,895, 17,540, and then here you're up $19,000 almost. And guess what? Your cash value is at 18,248. This is year 10. And that's what happens. And remember, this is just in case, because no one wants anything bad or fatal to happen to you, although we all face immortality, but no one wants this to happen to you. And then like these years, you have an increase, and I wanted to end the video, so I didn't want to just type it up, but all of these are increase years where this value goes up. Year 15 is about at, I'm looking at it here, I'm going to do it real quickly. Year 15 is about at 260,594. It's starting to go down. Wow. So it's going back down. So I drew the arrow the wrong way. Good thing I'm looking at this policy. So anyway, it's a cryptic joke. So it's going down, and then it levels right back at $250,000, and that was your face amount. Sounds kind of morbid, huh? You're getting interest on your death, but you're also getting interest on your cash surrender value in case you want to take that out. It's also allowing you to do that though not as large. And also you can say your life insurance policy can count as an asset. So that helps too. We're going to do more of these in the series and analyze some more of these. Anyway, keep in mind that past results are not always a guarantee of future rates. Also keep in mind this is an individual policy that belongs to one of the representatives here at Jacobit's Learning, and also not all policies are the same. And the younger you are, the more time you have to raise these values. And these values are going to level out with something we have, because this was called a level death benefit, something a lot of people don't like. Some people want it to increase. Some people say you're dropping value here and, kind of like gaining a little bit here. And you can always go back in and change these policies up until, I think Florida just changed it. It's the year 75. So if somebody is 71, 72 watching this, a lot of companies do stop insuring. A couple of years ago, it was age 78. And now they stopped insuring like at about age 75. And people are living longer, till 96, till 100, so you still have time to get one. Thank you for watching. Have a great afternoon.